Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. What if you could look inside the financial habits of 1,000 different investors, from people struggling paycheck to paycheck all the way to multi-millionaires, and identify exactly what separates the wealthy from everyone else? That's exactly what we did. And the results were shocking, because the differences between wealthy investors and average investors have almost nothing to do with income, luck, or being born into the right family. They come down to a small number of specific habits and mindsets that anyone can adopt starting today. Let's get into it. The single most common belief about wealthy people is that they got rich because they earned a lot of money. High salary, big bonus, lucky break. But when you actually analyze the data, this turns out to be almost completely wrong. Studies consistently show that income alone does not predict wealth. There are people earning 30,000 euros a year who have built substantial net worths through disciplined saving and investing. And there are people earning 200,000 euros a year who are essentially broke, spending everything they earn on lifestyle and accumulating almost nothing. The academic term for this is the difference between high earners and high net worth individuals. They are not the same group. In fact, research by Thomas Stanley, author of The Millionaire Next Door, found that the majority of actual millionaires in the United States live in ordinary houses, drive modest cars, and earn relatively normal incomes. The flashy lifestyle most people associate with wealth is actually more common among high earners who aren't wealthy than among genuinely wealthy people. The wealth gap isn't primarily an income gap. It's a behavior gap. And that's actually incredibly good news, because behavior is something anyone can change. The first and most universal habit among wealthy investors is something we've touched on before, but the data on how consistently wealthy people do this versus everyone else is staggering. Across the investors we analyzed, virtually every high net worth individual, regardless of income level, had one thing in common. They automated their savings and investments before spending anything else. The moment income arrived, a fixed percentage, typically between 20% and 40%, was immediately moved to investments. Automatically, without thinking about it, without deciding each month. Average investors did the opposite. They spent first and saved whatever was left, which was usually nothing. This single habit, paying yourself first through automation, accounted for more of the wealth gap between groups than almost any other factor, including income, education, or investment returns. The wealthy don't save because they have money left over. They have money left over because they save first. If you do nothing else differently after watching this video, set up an automatic transfer the day your salary arrives. Even 50 euros, even 25 euros. The amount is almost irrelevant. The automation is everything. This one surprises almost everyone. When most people imagine wealthy investors, they picture someone actively trading stocks, making bold calls on the next big opportunity, moving in and out of positions with confidence and precision. The reality is almost the exact opposite. The wealthiest investors we analyzed were almost universally boring. One or two broad index ETFs, automatic monthly contributions, zero trading activity, years, sometimes decades, between any significant changes to their portfolio. Meanwhile, the average investors in our analysis were constantly active, switching funds, chasing recent winners, reacting to news headlines, moving in and out of crypto, always looking for the next big thing. And the boring investors consistently outperformed the active ones by a significant margin over every long time period we looked at. This confirms what the academic research has shown for decades. Trading costs money through fees and taxes. Emotional decisions destroy returns. And the market rewards patience far more generously than activity. The best thing most investors can do for their portfolio is absolutely nothing. Set up a boring automatic savings plan into a broad global ETF and resist every urge to interfere with it. This is what wealthy investors actually do, regardless of what the media would have you believe. One of the starkest differences between wealthy and average investors was time horizon. When asked about their investments, wealthy investors consistently talked in terms of decades. What will this be worth in 20 years? What does my portfolio look like at retirement? How much will my children inherit? Average investors consistently talked in terms of days and weeks. Is the market going up this week? Should I buy before the earnings announcement? Is now a good time to get in? This difference in time horizon changes everything about how you invest. A long time horizon means market volatility becomes completely irrelevant. A 30% crash is just noise on a 30-year chart. A short time horizon turns every dip into a crisis that triggers emotional selling at exactly the wrong moment. A long time horizon means compound interest has time to perform its magic, turning modest monthly contributions into life-changing wealth. A short time horizon means compound interest barely has time to start working before you've moved on to the next strategy. A long time horizon means fees barely matter for individual transactions. But over decades, even 0.1% differences compound into tens of thousands of euros. Short-term thinkers ignore fees because they seem trivial. Long-term thinkers obsess over fees because they understand how dramatically they compound. The wealthiest investors weren't smarter. They weren't luckier. They simply gave their money more time to work and resisted the constant temptation to interfere with the process. The fourth habit is the least glamorous and arguably the most important. Every single high net worth individual we analyzed, without exception, spent significantly less than they earned. Not just a little less, significantly less. The gap between their income and their spending was wide and intentional. This sounds obvious, but the average investor in our analysis spent almost exactly what they earned, or more. Lifestyle inflation ate every pay rise. Every income increase was immediately absorbed by a more expensive car, a bigger apartment, more frequent holidays. Wealthy investors treated lifestyle inflation as the enemy. When income increased, they increased their investment contributions first and allowed lifestyle to expand only modestly, if at all. This is sometimes called stealth wealth, living a comfortable but deliberately modest life, while quietly building enormous financial security in the background. It's the opposite of the flashy lifestyle most people associate with wealth. And it's the reason so many genuinely wealthy people are impossible to identify by looking at them. The formula is simple. Earn more over time. Keep lifestyle growth well below income growth. Direct the difference into broad, low-cost index ETFs. Repeat for decades. It's not exciting. It's not Instagram-worthy. But it works every single time for anyone willing to do it consistently. The final habit, and the one that created the most dramatic wealth gaps in our analysis, was simply starting early. Across every income level, every country, every investment approach, the single variable that most reliably predicted wealth at retirement was how early someone started investing. Not how much they earned, not how clever their strategy was, not how well they timed the market, just how early they started. We saw this play out mathematically in the data over and over again. Someone who invested €200 per month from age 22 to 32, just 10 years, and then stopped completely, outperformed someone who invested €200 per month from age 32 all the way to 62. A full 30 years of investing. The early starter invested for less time and contributed less total money, but compound interest on those early years generated more wealth than 30 years of later investing. This is the power of compound interest at its most dramatic, and it's why every year of delay costs far more than most people realize. The best time to start was yesterday. The second best time is right now. Not next month when things feel more stable. Not next year when you get a pay rise. Today, with whatever amount you can manage. So there you have it. The 5 habits that consistently separated wealthy investors from everyone else across 1,000 different investors at every income level. Pay yourself first automatically. Be obsessively boring with your investments. Think in decades, not days. Live consistently below your means. And start as early as humanly possible. None of these habits require a high income. None require special knowledge or connections. They just require a decision and the discipline to act on it starting today. Subscribe to SimpleWealth for more honest investing content every single week. Drop your questions in the comments and we'll see you in the next one.